Hey, everybody, welcome back to Thrive, the podcast for business owners and business leaders who want to stay ahead of what's happening in the real world and what it means for running a company day to day. I am Gene Marks, and today we are breaking down one of the biggest things that every employer is thinking about heading into the new year, and that's top business regulations and compliance updates for 2026. So listen, if you missed it, Paychex recently hosted a webinar where I participated as well on the top business regulations of 2026. And we had a ton of great questions that came in from a lot of viewers of this webinar. These are both business owners, managers, employers. The good news is you can still watch the on-demand version, and we'll have that link to you in the show notes. But in today's episode, we're going to take it just one step further, okay? I am joined by Paychex compliance experts. These are the same people that were on the panel during the webinar. They're here to answer some of the most common questions we received during that webinar and to expand on the details that employers really need to understand as we're heading into the new year. So whether you're an HR leader or a payroll professional or a business owner trying to make sure that nothing slips through the cracks, this is a great episode to bookmark and share with your team. So let's get into it.
Welcome to Thrive, a Paychex business podcast, your blueprint for navigating everything from people to policies to profits. And now your host, Gene Marks.
All right, so first up, we're kicking things off with Bill Gosling, who is a compliance analyst at Paychex. Bill is here to help answer some of the top tax-related questions we received during our regulations webinar, including what employers need to know about no tax on tips and overtime, reporting considerations, and a few key updates to keep on your radar for 2026. So here's Bill. So Bill, we had a great time on the webinar. It was a pleasure speaking with you. I know that you were covering, all sorts of things that have to do with like no tax on tips, no tax on overtime. So we did get questions from the audience. And I wanted to throw some of these questions out to you so that we can get some specific answers to them. Okay. So,
yeah, sure.
So let's dig into it. First question come from one audience viewer. Just wanted you again to break down exactly what the responsibility of the employer is for this whole no tax on tips, no tax on overtime rule.
Yeah, sure. No problem, Gene. Really, from an employer standpoint, it's business as usual. You're still going to withhold all the FICA taxes. You're still going to withhold federal income tax from your employees' pay. Again, all these deductions come on the back end. These are when the employees actually file their personal income tax returns. They take these deductions. So from an actual payroll withholding, there's nothing different an employer needs to do. There will be some W-2 reporting that you're going to need to do. It is optional for 2025, recommended, but it will be mandatory for 2026.
All right, that's great. The whole optional thing, Bill, is what's freaking out my clients because it really does leave it up to the employer to do whatever they feel, I guess, is best for reporting. What are you telling your clients when it comes to reporting on both tips and overtime?
Yeah, from a Paychex standpoint, we are actually going and we're putting out there the tips and the overtime on the W-2s for our employers so that they give their employees the best information possible. We are cautioning them that for this year, but just because of the late guidance from the IRS, they're more estimated for 2025. For 2026, they will be definitely a lot more accurate. So just using caution that we are going to give you the information, but the employees still probably want to consult with their tax advisor just to ensure they're using the right information.
Okay, that's great. And I do want to reiterate, if you're a customer or client of Paychex, or even any reputable, good, payroll service company or an accountant, you very, very much want to lean on them for help this year because your employee is going to be knocking on your door, wanting to know those numbers when they start, filling out their returns. On tips, Bill, one of our viewers asked, what constitutes a qualified tip and which occupations are eligible for this kind of exemption?
Yeah, that's a great question, Gene. Basically anything in the service industry, restaurants, bars, anything in hospitality, any industry where you normally receive tips. And the IRS and the Treasury Department, they have put out a list of occupations. They're broken into a bunch of different categories, and it's roughly 70 different occupations that are qualifying for tips and overtime. I'm sorry, not overtime, just for tips. And it's basically anything that's voluntary, anything that's at the discretion of the customer to provide to the person. So mandatory service charges that a restaurant may charge, whether it's a mandatory tip for parties of X amount or more, or anything that they're just automatically adding. If you as a customer don't have the option to choose how much you're giving, that's not considered a qualified tip.
Okay, that's fair enough. I think that's pretty straightforward. I had one client joke to me that he's going to turn all of his workers into tipped workers, saying that, like, whenever an invoice is paid, it constitutes a tip from customers. And that's how we'll pay his people. But he's a manufacturer, so
Right.
obviously he was just kidding around, and that's kind of silly. So in the end, it is a lot of it is common sense as to what, the people that you would expect to be getting tips, like you said, they're in the service industry and they're voluntary tips. Those are the ones that would be eligible. Next, when it comes to overtime pay, what types of overtime pay would not be included in, or eligible for this deduction?
Yeah, the overtime gets a little bit complicated. It's basically just anything that's covered under the definition for the Fair Labor Standards Act. So it's just that 0.5% that traditionally falls as overtime. So if your employer provides holiday pay, or if they provide, you work on the weekends, you earn overtime, that's not considered qualified overtime for FLSA. So that's not qualified overtime. And then obviously if your state has a mandate for, if you work X number of hours in a day and you go over that, then that extra hours are overtime. That's not considered qualified overtime. So it's just that 0.5 over 40 hours a week covered under the Fair Labor Standards Act.
Good answer. I just did a webinar with Paychex. We were talking about all the new compliance issues that California business owners have to face,
Yeah, absolutely.
And you use the example of like state overtime. I mean, California's overtime, wage limits are higher, but that's not FLSA. So it is not all those overtime wages would be qualified for this, deduction that employees can take. So just to reiterate your point, if you're an employer in a state where overtime pay is higher than what the federal government has under the Fair Labor Standards Act, you have to really talk to your payroll tax professional and your accounting professional, because there's a likelihood that not all of that pay will be deductible, that your employees can take that overtime pay as deduction. How about maximums? Okay, we are, again, this webinar covered taxes on tips and overtime. And again, for all of you watching, remember, this is like the employees are taking this deduction, but not all employees can take this deduction. There is a maximum level of pay. Can you discuss the maximums where it starts phasing out?
No problem. So they're a little bit different for both. So for the tips, the maximum amount that qualifies for the deduction is $25,000 per return. And what that means is that if you file single, you get a maximum of $25,000 that you can use towards the deduction for tips. If you file married joint and both you and your significant other are in the service industry, you get a maximum combined of $25,000 that the two of you can claim as a deduction on your income tax return. Now, for overtime, it's a little bit different. The maximum is still a total of $25,000, but where it's different is that each individual gets their own separate $12,500. So if you file separately, you get $12,500. If you're married filing joint, you get $25,000, but you each get $12,500 that you can claim for the deduction limit for there.
Okay, that is good. Now there are some limitations though to income. Not once you start earning a certain amount, this benefit, this deduction starts to phase out? What
Yeah.
would that?
So yeah, the maximum income level for an individual is 150,000. For any joint filings, it's 300,000.
Right. All right. That's great. And that is for tips or overtime or
It's actually for both. It's actually for both.
Okay.
Yeah, they both have the same income level limits on them, so that at least it's easier to remember it that way.
Okay. All right. That is great. Super helpful information. So my takeaways are, again, from the questions that were asked at this webinar. If you're an employer, it's optional about reporting overtime and tips, income this year on W-2s, but there's going to be changes for 2026. Remember, everybody, that this is a deduction that your employees are taking. It really doesn't change anything from the employer's standpoint other than just reporting. But your employees need to know about this stuff so they can maximize their deductions if they're eligible for the tip deduction or the overtime deduction. Tips, there's certain amounts they can deduct up to. It's $25,000 per return. Overtime, it's $12,500, and then there's a maximum income level as well, around 150,000 individual, 300,000 joint, where these deductions phase out. So lots to know. If you are an employer watching this right now, please make sure that your employees are educated and make sure that you put these numbers together with your payroll specialist so that you are not inundated with requests when people start filling out their individual tax returns. Okay. On the webinar, Bill, that was where we talked about all these sort of, regulatory issues facing businesses in 2026. You talked about research and development deductions, right? So, for those that may not have seen the webinar, they might have R&D expenses, and this is a deduction. It's not the R&D tax credits, but the R&D deduction. Can you walk us through what you discussed?
Yeah. So with the One Big Beautiful Bill Act, there were changes that were made to the deductions that businesses can take on their income tax returns when it comes to research and development. Basically, what the law changed was that you can now immediately expense those costs and use them towards the deductions, starting with tax year 2025 and going forward. Anything you no longer have to amortize them over 5 to 10 years. They're immediate deductions moving forward.
Great. So we can now do that because before these R&D deductions, they actually stopped back a couple of years ago, which meant if you had any research and development expenses, they had to be capitalized and amortized over 5 years. Well, now we're back to, deducting them in the year they were incurred, which is a big tax benefit. Another big benefit, Bill, is that you can go back a few years, right, to 2022. Talk to me about, because a question was asked about that as well.
Yeah, so for 2022, so for businesses, they can take those and they can immediately expense them either fully on their 2025 tax return, or they can split them equally between 2025 and 2026. And then additionally, for any small businesses, and the way they define a small business is any business that has less than 31 million in annual gross receipts. What they can do is they can go back to tax year 2022 through 2024, and they can file amended returns for those years to capture those deductions. And they have until July 4th of 2026 to get those amended returns filed.
Oh, I actually didn't even know that. Okay, that's very interesting. And it is, so that's a big benefit. So, again, if you're running a small business and you qualify, we said less than 31 million in revenues.
Less than 31 million. Yep.
Yeah. And you had research and development expense that you fully did not take the deduction for yet, and you incurred them 2022 and beyond. You can go back and amend your returns and do that. It will lower your taxable income. It'll lower your tax liability, and you might get some money back. I strongly recommend that you do that. Bill, just because sometimes people get confused about research and development, are you comfortable talking a little bit about what that definition is? What does it mean? I feel like more companies are eligible for these expenses, then they know. You know what I mean?
Yeah,
Can you?
yeah, definitely. I mean, research and development, I mean, it's a pretty broad spectrum. I mean, anything you're doing to enhance your business, whether you're researching AI and implementing new AI features into your business, or any basic research effort that doesn't have to necessarily be in the vein of medical research or technical research, et cetera. As long as it's research that is um, being conducted to enhance your business and enhance your customer's experience, it's a good chance it's going to qualify.
Yeah, it's really good advice. And, and I tell my clients as well, like, hey, you do product samples, you're doing market research, you're, improving the capabilities of a product, and you need to, spend time. You've got costs of your chemists and costs of engineers or outside contractors or outside marketing people or consultants. All of those expenses may qualify for this deduction, and it's pretty significant. And if you're not taking it elsewhere, you're not using it elsewhere, it's something that should definitely be considered. I know we're not talking about the R&D tax credit, but that also figures into that conversation too. Whatever you're not qualifying for the deduction, you can use these expenses for this tax credit. So it's an opportunity for businesses to really, lower their taxes if they think hard about what's research and what's not. So strongly recommend that you do that. All right, final topic, and obviously this is pretty quick, but you had talked a little bit about the work opportunity tax credit, which expired. And one a visitor, one viewer that came to our webinar had a question about that. If you can just reiterate the status of the work opportunity tax credit.
Right. So the work opportunity tax credit expired on December 31st of last year. Usually in the past, for the last decade, it seems to get extended even when it's ready to expire. It didn't get extended this past year, so it has technically expired. I think the term that is being used in the industry, it's on hiatus, because there's a lot of anticipation, a lot of talk that it will get reinstated. It's just a matter of when. So it's very important that people, businesses, still go out there. Still go out there and hire people in these categories that may not traditionally have luck getting employment, because in the event that it is reinstated, there are some very beneficial tax credits that come your way with hiring individuals from these demographics. And so it's important, keep doing, if you have been doing it, keep doing what you're doing, continue with screenings. If you're thinking about it for the first time, there's still information out there. Do your due diligence, do your screenings, pay attention to state laws, because state laws might have specific requirements that you have to adhere to as well. But nothing's guaranteed, but there's a good chance that this is going to get reinstated, and hopefully it'll be retroactive to the beginning of the year, so that businesses can continue to take advantage of this very beneficial tax credit for everybody.
Yep. Yeah, I have two things to add to that. One is not enough businesses knew about the work opportunity tax credit. To me, I felt that was its biggest fault, because it really is helpful to businesses who hire people that are off of welfare, out of prison, out of the military, a whole bunch of different qualities. So hopefully if and when it comes back, it can be around more sort of PR around it. And then secondly, you did kind of mention it as well. Just because the federal work opportunity tax credit is going away, there are a number of states that do offer tax credits and incentives for hiring people that are disadvantaged, again, off of welfare, out of prison. So, don't just think there aren't those options available. Check out what your state has to offer as well. Well, Bill, you covered it all. We talked about tax on tips, tax on overtime. We talked about research and development deduction. We talked about work opportunity tax credit. These are all things that you discussed in great detail in our top regulatory issues facing businesses in 2026 webinar. For those of you watching this, there is a link to that webinar in the show notes. So if you want to see the full discussion with Bill and myself and others from Paychex on these and other issues, please click on the link and join us for that discussion. Bill, I want to thank you very much. Bill Goslin is a compliance analyst at Paychex. Your time is super valuable and your advice is even more valuable. So thanks for spending the time.
My pleasure, Gene. Thank you.
Next, we're joined by Jared Rutter. He is an HR services risk partner at Paychex, and he is here to break down multi-state compliance topics that came up a lot during the webinar, including paid family and medical leave, paid sick leave, and what employers need to know about worker classification heading into 2026. Here is Jared. Jared Rutter, thank you so much for joining. I am glad you and I have a chance to sort of catch up after the top regulatory issues facing businesses in 2026 webinar that we did together. Thanks for coming on the podcast.
Yeah, thanks for having me. I'm excited to be here today, Gene.
Good. So everyone, so Jared is is an HR services risk partner at Paychex. So he is responsible for a lot of these compliance issues. And on the webinar that we did, which by the way, again, a link to the webinar is in our show notes. Jared dug into certain issues that were up his alley: paid and family medical leave, paid sick leave, worker classifications, overtime rules, and all of that. So, this recap, this interview is really, your goal is to answer some of your questions that you had during this webinar. So first of all, before we even get into some of the specific questions, let me just ask for like a little recap, Jared. So the paid family and medical leave, tell me where this is. And I think the overall theme is federal government not involved so much. This is more of a state level thing. Fair enough?
Yeah, fair enough indeed. And it's not currently at the federal level a thing. We obviously have the paid or not paid FMLA, which is an unpaid leave. There are currently, and I stress currently, 13 states that have a form of paid family medical leave. And it's important to understand that what is 13 states right now could change. We never know. So one of the big challenges for employers is to keep tabs on what exists where and what is changing where, particularly for companies that have employees in multiple states. So if we put that 13 aside and we just focus on what is changing for 2026, there's a few changes. Delaware, they had deductions that were taking place or were supposed to take place by employers from employees in 2025. Starting January 1st, a few weeks ago, employees in Delaware are able to submit claim for benefit. And similarly, in Maine, similar type of situation in that the deductions were to be made from employees and payment remitted to states, but benefit eligibility for employees, that won't take place until May 1st, 2026. So we have a few months there in Maine. Minnesota, you are now, if you're an employee in Minnesota, able to take advantage of benefits effective January 1st, 2026. In Maryland, and again, a lot of this stuff is a moving target. Maryland has modified or changed, or delayed, I should say, their state paid family leave law. Now the deductions won't start until 2027, and then employee benefit eligibility will take place starting in 2028.
Got it. We got a bunch of people that are watching or listening to this, Jared, they're from all over the country. So, I mean, we can't spend a lot of time on any one state without, sort of alienating everybody else that's not in that state. But let me just ask you, number one, what do you, just generally, if you can, how does an employer treat an employee who is working out of their state, but they're in a state where these paid and family medical leave, mandates exist? How do you determine that? And also, only because I do have clients with this, what if an employee is working from multiple states? I mean, I was just at a trucking client, a logistics company, and they have truck drivers that, they're driving through multiple states. That's their job, 3 or 4 states at any given time. You know what I mean? How, just generally, is there like a rule of thumb how these things usually get handled?
There unfortunately isn't. And this is a question that we get fairly regularly. And in HR, it depends is a term or phrase that is used fairly regularly. And this is one of the ultimate, it depends. It depends on a number of factors. It depends on is the employee in a state in which they satisfy the eligibility requirements. So when looking at that, if you have an employee that is bouncing back and forth from state to state, they might be eligible in one state, but not eligible within another. And that can, to your point, if you have a truck driver, we see this pop up with outside sales reps that are covering a large region that is covering multiple states. And the question of, okay, well, if they're working in California, Arizona, Nevada, New Mexico, so on and so forth, which law do we follow? And the reason it depends, in addition to eligibility requirements, is certain laws do a better job, certain states do a better job of specifically indicating who has to be covered. Do they have to actually be sitting and working in that state? Or if the point of direction is coming from in a state and the employee, for example, doesn't have a home base or home office and they're literally bouncing, flying around the country, would they in fact have to be provided this benefit? So when there is ambiguity and question as to whether an employee is or is not to be covered by a state leave law, or there are scenarios where there are multiple states with multiple leave laws, if there's uncertainty, it's usually, not always, but usually going to be in the employer's best interest to touch base with an attorney and talk through some of that stuff. And I mentioned it last week, but some of these laws do have unknowns. They're just written vague, and they're written so vague that there isn't necessarily a clear answer. And a lot of times there's clarifying guidance that would come out after the fact, but I hate to sound like I'm ducking the question, Gene. I really do, but
no,
there's just not a black and white answer.
Yeah, I've always, I'm always one, like, less regulations, the better. I think any business owner like myself feels that way. You would think that, like, the federal government's leaving, hands off and leaving these things to the states. I do support states, they know their people better, you know what I mean, than the federal government does. But boy, does it create complexities for a business owner. And I guess the takeaway is, like, if you are operating in multiple states, if you have employees in multiple states, if you have employees moving around between states, I just think it's just, just de facto that you're going to have a labor attorney, a payroll expert like Paychex, a good accountant, somebody that's going to have to help you comply with this stuff, because that's a lot.
Because it's not like, you're a CPA, so you're familiar, I'm sure, with determining what state unemployment tax is paid to. And you work sequentially through, it used to be 4 rules. It's been a minute since I was in payroll, but you would work down those rules. It's not necessarily that clean cut and easy with this type of a law.
It's not. And I guess another question got submitted, which I think you already answered. The question was, what about seasonal workforces, seasonal employees with permanent addresses in different states? Which regulations apply? And I'm going to answer for you because you've already said it. It depends, right? What states that are involved. Is that a fair answer?
It is. And with seasonal workers, one of the key focal points in working through, an analysis or list of considerations is how many hours are they working? Are they even eligible? If they're only working, the holiday season, very, very temporary, and they're not working very many hours, they very well might not be eligible to begin with. But in the most basic sense, usually it's going to be where the employee sits and is working. That would be the state and the law that would be applied. And where things start to get muddy is the example you brought up, moving from state to state, traveling remote, doesn't necessarily have a home office. So a lot of considerations And to your earlier point, CPA, attorney, and of course, we're able to help our clients with a lot of that as well. And if we reach a point where we feel like, well, Mr. or Mrs. Client, it's going to be in your best interest probably to talk to counsel, we'll make that recommendation as well.
Okay. And I do want to reiterate for those of you that are watching or listening to this. I mean, again, not blowing this off or not being compliant with this stuff, not great. I mean, again, I've seen this with client after client. It gets classified or at least reported as wage theft because you're not paying or providing these benefits to people. And it is not exactly the PR as a business owner that you want to have. So it just underscores the importance of paying attention to this stuff. And speaking of that, so Jared, moving on, you also discussed in our webinar about paid sick leave. So in addition to paid family and medical leave, where many states have mandates for employers, 20 states have mandates for paid sick leave. So give us an update on where paid sick leave stands as a mandate across the country.
Yeah, it's a lot more prevalent.
It
It's been something we started seeing now at this point, probably like 15 years ago. And I made mention that usually these laws start from the coast, work their way in. At the federal level, there is no requirement. So there's nothing that you really need to, as an employer, be aware of from a federal perspective, unless you are a federal contractor. And then there may be a need for you to provide paid sick time as a requirement. There are 20 states currently that have requirements. We're not going to dive into each and every one of those states. This is intended to be more high level overview. But it's important to understand as well that there are also quite a few localities within specific states that have their own paid sick leave. And there can be slight differences between perhaps what the California state law is versus what the San Diego paid sick leave law is, or Los Angeles. So that's important to consider and can be challenging to navigate as well. There are, not to make this even more complicated or sound more complicated, but certain states have industry specific requirements and some carve outs as well. So you might be in a state that has a required paid sick time benefit for your employees, but you don't have to follow it because you fall into an industry in which there's a carve out, or, there are certain industries within certain states in which you maybe wouldn't otherwise have to provide that benefit if you were not in a specific industry. So when we talk about changes for, there's nothing new. There are no new states that are rolling out a paid sick leave law. There are a few changes in 3 states, California being one of them. They have expanded their usage eligibility. So you are now able in California to use paid sick time should you be in a situation in which you have to appear in court or you have to serve jury duty. And that would be for any scenario where you're the victim of, or a family member is a victim of a serious crime. And so that's what's going on in California. Similarly, when we talk about usage rules, Oregon has modified their usage eligibility. You're also now in Oregon able to utilize paid sick time if you are going to give blood. And then while not necessarily just related to usage, Connecticut would round out the 3 with 2026 modifications. And that modification is a change in the employee threshold, which would be used to determine whether or not an employer is or isn't a covered entity under that law. So what was in Connecticut 25 or more employees for eligibility or to be a covered entity as an employer, that number has been brought down to 11, which is pretty significant when you start to consider the fact that you're pulling some relatively smaller size companies into that coverage.
And I'm assuming, again, it does depend on the state, but I'm curious if are most states, do they allow employers to require proof from their employees that they were sick? Is that a general thing that employers can impose on their employees?
Yes and no. And I hate to go back to
It depends.
But there are a number, usually not all, but usually the law is going to, or ordinance is going to specify whether you as an employer can or cannot request that substantiating documentation from an employee. I think what you'll find most commonly when you go out and start to look at the various laws and ordinances that exist, they usually tie it to 3 consecutive days. After that third day, you're then able to request documentation. This is a question, frankly, that we get quite regularly, even outside of the realm of paid sick time usage. There are other factors that really need to be considered, even if it is something that is technically permissible under the law or the ordinance. You take on certain forms of risk by having that practice in place. So you need to have a policy that stipulates that you're going to do it. You need to consider past precedent. What have you done in the past for other employees? Have you been rock solid and consistent? If you haven't, and now you have this one employee that you're going to ask for this documentation, the optics there may be, exactly, are you treating this person differently, or more importantly yet, is it perceived? Do they perceive you as treating them differently because of a known medical issue? And it can, in certain situations, open the door to suddenly becoming aware of a medical condition that could meet the definition of a disability under the ADA or state, local equivalent laws. So personally, it's typically not something I really recommend to do, whether it's part of a paid sick time policy or not. I'm just of the opinion that there oftentimes is more risk in having that as your practice than benefit gained. Recognizing, however, that there are certain industries in which it just makes sense because there can be abuse of that policy on the employee's part or perceived abuse. So no one size fits all answer to that question. But
no, it's okay. It's okay. It's just, one of the things I also keep in mind is that if you are requiring, proof that an employee was out sick, just, you got to be careful for your employer, for HIPAA rules and healthcare privacy rules. Sometimes things get disclosed that, in a sick note that you might, or you shouldn't be knowing about, and that could be a potential problem. So, there's all these different things to navigate. Okay. Enough about that. Let's talk about really our next final issue of the day is just worker classification rules. So this is classifying people as employees versus independent contractors, where it's gone back and forth. So Jared, where do things stand now nationally?
Nationally, to start off, it's been all over the road, and it's largely been dependent upon which administration happens to be in power, and the focus by some on one side of the political spectrum to have a want or desire to make the classification of a worker as an independent contractor easier to do. Conversely, some argue that it's more beneficial to have the ease of, or making it more difficult, I should say, of classifying somebody as an independent contractor. And I'm not going to get into what's good, what's bad, what my personal perspective is on any of that. That's not what we're here to talk about today. But at the federal level, with regards to change and this being somewhat of a moving target, we're in a place right now in which a lot of this is being kind of held up in court. So litigators are attacking it. But we're now in a place in which we are referring back to Fact Sheet 13, which was the law of the land way back in 2008. And there have been multiple changes since then, which here again, I don't want to get into the history of worker classifications, not a good use of our time. But what's important to understand is that we are now back to that 2008 Fact Sheet 13 and the 2024 rule that is going to have a 6-factor test. And with that 6-factor test, you're looking at certain types of things that are going to be more relationship based. So you're looking at the type of financial reliance that the worker has on the company, the amount of control that the a company has over the worker. There are a variety of different, at the federal level, things that would be looked at. And you look at the relationship in totality to try to come to the conclusion of whether the worker is or is not appropriately classified, if classified as an independent contractor. So as it pertains to these changes and what's coming, it's really important that if companies are utilizing independent contractors, it's really important to keep tabs and keep up to date as to what is happening, because these things are happening quickly. And once it's locked in, being that we are, as you know, early on in the current administration, once locked in, they might be locked in for a while. Moral of the story, we don't really have a way to know for sure at the federal level where they're going to land.
Right. Jared, you had actually mentioned to me, separately that you often get, this question was not asked during our webinar, but you often get it. Business owners or employers will ask, what if a worker wants to be paid as an independent contractor instead of an employee? How do I handle that? And, that's happened to me numerous times. It's enticing for an employer just to pay somebody as an independent contractor, but that might not always be kosher. Can you expand on that?
Yeah, they can make the request, but the reality is if they aren't an independent contractor based on federal, state, or some local law or the test that exists within each jurisdiction, you can't classify, or you shouldn't classify someone as an independent contractor just because they want to be classified as such. So if you look at this big picture, when you have someone that you're paying as an independent contractor from an employer perspective, you're not paying taxes, right? You're not paying any taxes on the dollars that are being paid to that independent contractor. Good, bad, or indifferent, government agencies may have a vested interest in getting those tax dollars from more employers. But there's also this focus on ensuring that an employee is provided employee benefits. And if they're misclassified as an independent contractor, they're not eligible for benefits. If you have an independent contractor that you're providing benefits to, I would encourage you to get with someone, whether it's someone with Paychex or, CPA, attorney, because that can be a fairly decisive indication that what is perceived as an independent contractor perhaps is not. But it is a question. I can't say that I fully understand the want behind those requests. I suspect it primarily has to do with the fact that taxes aren't being withheld. The worker would be responsible for paying their own taxes after the fact. So take-home pay is theoretically higher. We don't need to get into that in a lot of detail, but it's not an option. It's similar on the wage and hours side. Periodically, we get the question of, well, my employee wants to work, but they're looking to waive overtime. They can't waive overtime. If they are working overtime by law, an employer has to pay them. So it's not a waive or a choice that employees or workers are able to make.
And speaking of overtime, our final topic, I'm speaking separately with Bill Gosselin about the no tax on overtime rules. So we don't have to get into that. But the overtime rules themselves, have, I keep saying this, they've changed and then they change back, So where do we stand? And I guess from a federal standpoint, and if you want to touch on state, that's fine. But just a quick recap, where are we on overtime pay? What is what should employers know?
Currently, things haven't really changed from a salary basis test perspective. We're still working off of what was a 2019 increase.
Right.
Been held up in court or challenged in court. So what's important to understand, however, is that the salary basis test, basically meaning you have to pay your exempt workers a certain dollar amount. It needs to be paid in the form of a weekly salary or weekly salary equivalent that can't be deducted from. At the federal level, you can incorporate up to 10% in like supplemental wages. That could be bonuses, that could be commissions, certain types of lodging. But that's only one piece of the calculus as far as how you would determine whether or not a worker is or is not an exempt employee. So while there haven't been any changes and we're still looking at that that 684 at the federal level, that's only one piece of the puzzle. And there's the duties test, which focuses on what the employee does and doesn't do. And that tends to be a far more complicated analysis. Here again, we work with our clients regularly to help them establish what is perceived as being the appropriate classification, exempt versus non-exempt. So we do a lot of work in that category, but salary and salary only, that hasn't really changed. And the same could be said, frankly, for the duties side of it.
Okay. And just to make sure, like, there were changes proposed under the Biden administration and they got hung up in the courts. So everything was like not changed while they were being battled out. And now under this administration, the government's not pursuing that. So what you said is it's still the same as it was back in 2019, despite the proposed changes made by the previous administration. Is that a fair statement?
And it's kind of a been there, done that type of situation as well, because this is the second time that we've run into this. And
happened under Obama.
It's somewhat unfortunate in how the timeline has played out, because we had a lot of clients that were making decisions based on the assumption that the 684 was going to be increased. And it was a fairly significant increase. I don't remember the exact dollar amount, but I want to say it was somewhere in the $900-ish a week, which would have been that new salary threshold. So we had clients that came to the conclusion that, well, we can't increase employee ABC's salary to a weekly equivalent that it's that high. Therefore, we're just going to be proactive and change these workers to non-exempt, only to find out that they never really had to make that change in the first place. But it's always going to be a risk that you take. You go back to earlier in our discussion, the Maryland law, paid family law, that has been delayed. You prepare, assuming sometimes things get pushed back or get erased. The flip side of that is you're not prepared and you don't have the things in place that you need to have in place, thinking, well, maybe this law won't go into effect, or I heard that it may be challenged and held up in court. That's usually not something that we would recommend, because it puts you in a situation in which you're exposed to potential wage and hour risk.
So everyone, Jared Rutter is an HR services risk partner at Paychex. Him and I have been discussing some of the questions that were raised from the webinar that we recently did called Top Regulatory Issues Facing Businesses in 2026. A link to that webinar is in the show notes. Jared, thank you so much for your time. I look forward to seeing you again for another webinar, hopefully sometime later on this year, where we'll update our clients about what they need to know to make sure they stay in compliance. So thanks for your time, Jared.
Absolutely appreciate the opportunity, Gene.
And finally, we are wrapping up today with Zach Keep, Manager of Risk Compliance at Paychex, covering one of the biggest retirement compliance updates for employers, mandatory Roth catch-up contributions under Secure 2.0, and what companies should be doing now to prepare. It's kind of a big issue, something to pay attention to. Here is Zach. All right, everybody. I am with Zach Keep, who is a manager of compliance risk at Paychex. He specializes in retirement, which is what we're going to talk about right now. Zach joined me on the webinar that we did. Of course, the top regulatory issues facing businesses in 2026. There was a link to that webinar in the show notes, as you probably know by now already. But there were some questions that came up during the webinar regarding some of the topics that he talked about, specifically Roth plans, and also on tax credits as well. We're going to try and get into. But first of all, Zach, thank you for joining. I'm really glad that you're here.
My pleasure, Gene. Always great to get the chance to sit down.
It is. It's actually always fun talking with you. So I'm glad that we have another chance to do so. Okay, let's start with Roth plans, which are growing in popularity as people become more and more familiar with them and understand what they do. So before we get to the specific questions that were raised, can I just ask you to just give a brief overview description of what a Roth plan is?
Sure, absolutely. What is Roth? Well, Roth is, think of it like a normal 401k, just turned upside down, right? The 401k that we all know and love, what most people think of is pre-tax deductions. The dollars that you contribute from your paycheck are contributed before taxes. they're invested, they grow, and then in retirement, you have, your tax hit, basically. When you take those dollars out of that 401k, 457, 403b, that's when you're kind of squaring up with Uncle Sam. Roth is exactly the opposite. With a Roth contribution, you are satisfying your tax burden right up front. And then those dollars are growing in a tax-free fashion and are not taxed upon distribution. So for certain types of employees, for certain types of investors, Roth has really been an attractive option, and we've seen a lot of growth of it over the years.
All right, that makes sense. And Zach, just and also to be clear, thanks to the Secure 2.0 legislation, which passed back in 2022, employers can now offer Roth 401k plans in addition to their traditional 401k plans, correct?
Well, yes, but that's not quite thanks to Secure 2.0. Roth has been around, obviously, for a very, very long time. Not every plan has permitted Roth. And I think that's for a number of reasons, lack of awareness, just the perception of complexity, whether that's accurate or not. But Roth has been an option in the 401k world for, decades now. I think it's fair to say not the most heavily utilized option, but certainly an attractive option for certain classes of investors. And obviously now, thanks to Secure 2.0 and some of the mandates tied to Roth, now not so much an option, I think, in a lot of plans.
All right, yeah, that's really good to know. And I've been saying that to my clients though for a while now. I think it's a no-brainer if you're offering a traditional 401k to also offer a Roth 401k. It's just another savings vehicle for your employees, another benefit to provide. And I think it's, certainly affordable to do. So what, in our webinar, you talked about some of the changes that are restated, some of the regulatory things you need to be looking forward to in 2026. And a lot of it has to do with catch-up contributions to these Roth plans. So talk to us about that, because there were some questions about it.
Sure. So like we talked about, Gene, historically, Roth has been an option. It's been a thing. Some people love it. Some people don't like it. Some plans offer it. Some plans, refuse to offer it. All of those were fine. But thanks to Secure 2.0, let's take a step back, I guess. When something like Secure 2.0 is enacted, one of the questions is how are we going to pay for it as a nation, right? One of the pay-fors in Secure 2.0 is the Rothification, which is kind of the word the industry has made up, the Rothification of catch-up provisions. And what this means is that for the first time, certain individuals making certain contributions, we'll talk about those details in a moment, but for now, certain individuals making certain contributions must do so on a Roth basis. Now, why? What's the pay for there? Well, the pay for is, honestly, Uncle Sam gets that tax revenue right up front. It's not a pre-tax contribution. It's a post-tax contribution. The revenue comes in, and now that's kind of how we're paying for the infrastructure associated with Secure 2.0. So who needs to worry about Rothification? Well, you need to kind of fall into two distinct classes. The first is you need to be making what are called catch-up contributions to a 401k plan. Now, a catch-up is something that, for our purposes here, let's keep it simple. We're going to say for individuals who are over the age of 50, those individuals have, for a very, very long time now, been entitled to contribute above and beyond what their base limit is. So the limits themselves, we all know, change year to year. This year, $24,500 is the base limit. If you are a participant in a 401k, if you're 18 years old or if you're 49 years old, that's what you can contribute. If you're age 50 or older, you are entitled to a catch-up of an additional $8,000. So the first demographic that this is going to be targeting, or I should say the first half of the demographic, is those who are utilizing that catch-up provision, those who are over the age of 50 and contributing above and beyond their base limit.
And if I can just interrupt you and just ask, do you mean catch-up contributions to your traditional 401k? Is that what you're referring to?
Let's call it our 401k in general, because we're going to get into that Roth in just a moment.
Okay.
So if you are over the age of 50 and you are contributing a catch-up contribution, you can absolutely contribute it to your traditional 401k or to your Roth 401k if you want. But, and here's the crux of it, there's another hoop to jump through. If you are what we're calling a high earning individual, if in the last tax year you made more than $150,000, then you must contribute your catch-up as a Roth deferral. That's what's new with Secure 2.0. Catch-up isn't new. Roth isn't new. You can always contribute a catch-up. You can contribute a catch-up to Roth if you want. But now if you're in that kind of high earning bucket, you must contribute your catch-up as a Roth contribution. And that's the pay for in Secure 2.0. That's what we're talking about when we say Rothification of catch-up provisions.
So let me make sure I understand this. So let me just talk about the people making more than $150,000, because I have a lot of clients that are, in that boat. Say they don't participate at all in a Roth plan. Say they just have a traditional 401k and they don't have anything going on with Roth. Does this, mandated catch-up contribution apply to them?
Well, not a mandated catch-up contribution. The catch-up is always optional, right? Every individual decides how much he or she wants to contribute to their 401k. So if they're contributing at the base limit, that 24.5 that we just talked about, Gene, they can contribute that however they like. They can do it to a standard 401k, traditional 401k, pre-tax. They can do it Roth. They can mix it up. They can do a little bit Roth. They can do a little bit pre-tax. That's fine too. If they're using that catch-up contribution and their income is over that limit, if they meet both of those qualifiers, then only that portion, which is the catch-up, needs to be Roth. That's where they lose the option. So a good example would say, let's say I'm the owner of Zach's Small Engine Repair. That's my favorite company. And I can contribute up to my base limit. The 402G limit is what we call it in the industry. You can contribute up to that however you like. You retain the freedom you've always had. Only that extra, only those dollars contributed under the aegis of the catch-up would need to be Roth.
Got it. Okay. That makes complete sense. Let's keep going with this. Now, this is, there are other plans besides just 401ks. There are 401ks, there are 403bs, there's 457 plans, there are others. Tell us what this provision applies to. And if you can also, for our audience, just explain to me what the difference are in those plans.
Yeah, absolutely. And it's interesting, Gene, we sometimes forget about that. We're so focused on 401k. I think it's fair to say that, in America today, retirement is often synonymous with 401k, but everything in Secure 2.0 or most everything, certainly the Rothification piece is applicable to more than 401k plans. So what we would be looking at here would be 403b retirement plans, and also 457 plans. Now, to your question, how are those plans different? As a general rule, if I had to sum it up, I would say they really aren't that different. All of these plans have similar limits. When we get into 403b, there's maybe a couple of different catch-up provisions tied to years of service. 457 plans have some very esoteric differences, but I think it's fair to say that if you have, 100 participants for 99 of them, those plans are interchangeable. We see 403b is essentially the 401k of the nonprofit world. We see 403bs in K through 12 school districts, nonprofits, things like that. Whereas 401k is much more common in the for-profit realm.
Makes sense. Okay, that's great. All right, so we have a lot of employers that have watched this webinar, and we've had questions from a few of them about, well, how does this affect me as an employer? I mean, if you and I are employees and say we make more than $150,000 or we're required to make a catch up, to Roth, it's kind of on us, to do that. Do employers have responsibilities too?
Yeah, they do. I think they have they have responsibilities at both the strategic level and the tactical level. You know, for let's kind of start strategic. We'll work our way down. The first question is, if you are offering a 401k plan and you or one of your employees wants to utilize catch-up provisions and they qualify, they're making above that 150,000, right? Their contributions need to be Roth. So the first question to ask yourself is, does my plan permit Roth contributions? Because if it doesn't, the door to that catch-up kind of closes. So I think right now employers should have ideally already asked, but certainly should be asking if they haven't already. You know, do we permit Roth, and look into amending that plan document? Because without the ability to make Roth contributions, that catch-up option, you know, that door is closed. There's the first big one. And I think, you know, the second big one is a little bit more administrative. It's going to fall to the employer to properly report who earned what to their plan administrator, or to track it themselves if they're administering their own plan. And maybe this is a great time to think about a third-party administrator or a TPA if you're an employer doing that. But yeah, you know, you're going to need to know who is affected. You're going to need to know when they're hitting their base contribution limit, when catch-up kicks in. So yeah, there's some administrative work that is going to be ongoing work. Plan document amendment is kind of a one and done, but
Right.
The administration of this is going to be something employers will need to watch. Yep, and not for nothing, explain to their employees.
Okay, so let me beat you up on this just a little bit more,
Yeah.
because to make sure I'm completely clear on this. Say I'm an employer, I've got however many employees, I've got a traditional 401k plan. I do not have a Roth plan, but it's just a traditional 401k. I've got an employee that's making more than $150,000, and that employee has maxed out on their contributions to the 401k, and they want to make catch-up contributions, right? So for starters, I have to be smart enough or aware enough to say to the employee, you cannot make any more catch-up contributions to our 401k plan because you've hit the limit, and your catch-up contributions have to be to a Roth plan. We don't have a Roth plan, so make it to a Roth plan if that's what you want to do. And am I done as the employer? As long as I've notified the employee of this, are you saying that, like, I have to have a Roth plan option for the employee to contribute to?
I think the key word there is option, Gene, because you've got a 401k plan. Whether it's standard or Roth, it's your 401k. And then within that plan, you have Roth and standard. So it's not like it's a separate plan. So the catch-up is limited to the 401k. I think in the scenario that you outlined, the conversation would be a little bit more blunt. And I'm afraid it would actually be more like, employee, you can't utilize the 401k catch-up. There is nowhere else for you to contribute this. It's not like an employee can go start their own Roth. It's an employer-sponsored plan. So as an employer who didn't offer Roth, the conversation would be, we're sorry, this isn't an option for you.
Right. That is a clear answer, and I appreciate that. Which brings me to the next question that was asked from this webinar, and it's related, so maybe we're overlapping a little bit. But again, what if you just said, you have a 401k, you've got the traditional, and then you've got the Roth, part of the plan. But I do have clients that only have traditional 401k plans.
Oh, sure.
They do not have Roth plans, available. So what about them? Like, what is the limit of their responsibility when it comes to these catch-up contributions? I know you've you've already mentioned this, so let me ask you just to say it again.
So I think if I were an employer self-administering a 401k plan and I were, for whatever reason, dead set against Roth contributions, I am not going to have a Roth option available in my 401k. Employer responsibility is to look at who's earning above the $150,000 limit. And by the way, that limit's going to change. That's going to be indexed. So every year, you're going to need to look at your employees. You're going to need to look at what they're contributing, and at minimum, prevent them from utilizing that catch-up if they make over the earning limit, the 150 for this year, and it'll go up in years to come. I think that's the bare minimum. I would say that an employer would probably be well served by kind of projecting who's on pace to utilize that catch a provision and let them know sooner rather than later. That would be necessary, no, but probably it would be appreciated by the employee.
What happens if we mess it up as an employer and they hit the limit, but then they're like, no, I'm going to contribute another $8,000 to my 401k, and that person is making more than $150,000, and we let them contribute that $8,000 to their traditional 401k. What's the exposure to the employer?
That's a good question, and it gets complex pretty quickly, Gene. I think how that would play out most likely is those contributions in the end wouldn't be invested. They would come back to the employer. Yeah. I think, I certainly hope, I can speak for Paychex and say, we wouldn't let that happen for one of our clients. But if you are a kind of a standalone administrator, I think it's fair to say that your investment provider themselves is likely to intercept that.
Yeah, I think the takeaway that I get from this, Zach, is that it's a headache for employers. It is an administrative responsibility, potentially fiduciary, but definitely administrative responsibility. And you really have to have talks with your administrator, whether it's Paychex or whoever else is administrating your plans, in advance, and say, okay, what employees do we have that are, say, making more than $150,000? What are they, who is potentially, going to be an issue, and sort of head them off the pass, to avoid having to go back and correct errors and upsetting people. Nobody likes surprises. And I think that it's important to plan that ahead. Right?
Yeah. I think at this point, it's difficult to argue with more choice in a plan, right? That's a hard thing to say. It's bad to have more choice. I think as I look at the complexity of what is involved with watching this in perpetuity versus what's involved with simply offering Roth, I think a lot of employers might say, all things being equal, it's easier to just allow for Roth contributions and let this happen as the government intended, rather than dealing with the ongoing administrative burden of watching this simply to avoid offering Roth in a 401k.
Good. All right, great stuff. One final question then, and just very quickly, we didn't go into like huge detail about this during the webinar, but your questions always come up about the tax credits that are available for businesses under Secure 2.0. Can you give us just a quick? It's been since 2022, and I still don't feel people are really aware of the credits, the benefits available to them. Can you just recap what employers should know?
Yeah, in brief, I will. Gene, Secure 2.0 followed on the heels of Secure 1.0, as the name implies, and it really extended the tax credit paradigm. The government is attempting to encourage employers to offer a 401k plan, and they're doing that by financial incentives. Honestly, right now in 2026, an employer establishing a new 401k plan. That is the employer who's getting off the bench. They haven't offered one in the past. They think it's time to. They can offset their startup costs, 100% of startup costs as a tax credit. If that employer chooses to do an employer match, there's another tax credit available, offsetting, initially 100% of up to a certain limit, kind of phased down over the years. But bottom line, additional tax credits designed to encourage an employer not just to offer a plan, but to offer a fully featured plan, to give people that match, probably to give them all of the bells and whistles that they can. And that's easier than ever before. We have things like the pooled employer plan that takes the fiduciary burden and the administrative burden off the employer. So what we're seeing is these tax credits are driving employers to 401k. More new 401ks recently than we've really ever seen before. Especially you've got states that are mandating retirement plans. Employers know, hey, I can do the state plan or I can satisfy that mandate by a 401k. It's a better plan, more flexible plan, and I can get tax credits for it. So that math, I think, is pretty simple for a lot of employers out there.
Zach Keep is the manager of compliance risk at Paychex. We spent some time together on our well-attended webinar, the top regulatory issues facing businesses in 2026. You can get a link to it in the show notes if you want to go back and review it. Zach, as always, it's great having you on. Thank you so much for spending the time.
Always a pleasure, Gene.
All right, everybody. My name is Gene Marks, and I want to thank so much Bill and Jared and Zach for great information, giving us everything we need to know regarding staying in compliance for all the new rules and regulations that are affecting our businesses in 2026. Now, they just answered some specific questions I had. You can get the full details and listen to the full conversation by joining us on this webinar, which is pre-recorded and available for you to view whenever you want. There is a link in our show notes for you. I am telling you, if you are an employer, a business owner, a manager, HR professional, payroll manager, or payroll professional, you're going to want to watch this webinar. So again, click on the link in the show notes. Hopefully you will enjoy, and we'll see you in the next episode of Paychex Thrive. Take care. Do you have a topic or a guest that you would like to hear on Thrive? Please let us know. Visit payx.me/Thrive topics and send us your ideas or matters of interest. Also, if your business is looking to simplify your HR, payroll, benefits, or insurance services, see how Paychex can help. Visit the resource hub at paychex.com/works. That's WORX. Paychex can help manage those complexities while you focus on all the ways you want your business to thrive. I'm your host, Gene Marks, and thanks for joining us. Till next time, take care.
This podcast is property of Paychex Incorporated 2026, all rights reserved.